Hello everyone. In this video, I'm going to cover my investment journey as a 25-year-old person who's living in India. So I think I started my first investment journey going back 20, like 3-4 years back. But even though I was working in the investment analytics industry per se, I was really afraid to invest in equity markets because you always have this kind of taboo, right? Like when it comes to equity markets, it's just very difficult to understand them because you have so many mutual funds, you have so many people talking about stocks and options. Then I went down, through this well-known kind of a route for people who are not that knowledgeable or scared of investing is going through a mutual fund distributor. Then after investing with a mutual fund distributor for 5-6 months, I kind of eventually I end up quitting the mutual fund distributor because I read a lot about mutual funds and ETFs and almost like about all the global funds in the world. Then I got to know that no, this is not for me. I think I can do better with my knowledge. So ended up quitting, and I slowly started investing in other instruments, mostly like passive funds, right? Previously with that mutual fund distributor, mostly I had only active funds. I didn't have any passive funds at all. So this means mostly the small cap, mid cap funds, right? Then I ended up investing mostly in Nifty 50. Then I started diversifying. Then I started, my assets into gold, some of my assets into fixed income and bonds. Then my investments currently they are just pretty much everywhere, right? I'm hoping like if you're watching this, like your investments also like kind of everywhere, right? Like you probably might be invested in more than 10-15 mutual funds. So this is kind of my investment journey on how I kind of read about a lot of things, especially about the Indian market, but also kind of what's happening outside India, right? Because we are living in India, we always talk about India as a country, right? It's doing well. You have to invest in Nifty 50, or you're going to get the market returns, all that stuff. But is it sensible to even invest in a single market that is Indian market, right? I'll get down to a lot of those things in a few minutes. So this is my portfolio currently, right? Not the greatest portfolio, or I wouldn't say even the worst because like I don't have any active funds here except the Axis Global Equity Fund, which again I invested in for another reason. So most of my funds are in like bonds currently. The reason being is that not because um, I think like equity markets are risky or anything else, because like for the last 6-7 months I'm mostly on the research mode on where to invest, right? So this is like I want to invest in one place and don't stop thinking about, hey, I don't want to think about and mix and match, pick and choose all these kinds of mutual funds, right? You'd be surprised to hear, if you don't know, there are about 200,000 mutual funds across the world, more than 200,000, right? About 30-40,000 plus um ETFs. So if you think investing or investments are easy, it's not, right? Because you have so many theories, you have so many mix no options to choose. Almost every time you choose something, some other thing looks better, right? If you compare one or two portfolios, right? So I want to just kind of log on like how my investment journey has been, right? And yeah, so currently I have like a lot of bonds in it, right? The reason being is like being on the research mode, as I mentioned, and I moved a lot of my assets to mostly liquid funds, so that once I decide on where to invest, I can quickly move my money, right? Instead of putting all my money in equity markets and suddenly, let's say, Nifty drops by 10-20%, right? It can happen in about like a week or so, right? So this is my current portfolio, and where I want to start off is this so-called talk about valuations. If you're not sure about valuations, well, I'm also not an expert in valuation. In general, like there is this kind of like a valuation chart, right? Like I can also even Google valuation versus expected returns of the US market. So what you will see is the higher the valuation, your expected returns kind of comes down. So it's like some sort of a chart like this, right? So where currently the P ratio is so-called, when was this written? It's like 2024, like about like 6 7 months back. So what this person is saying is that currently we are kind of at a very high PE ratio. So you can see that the x-axis is the PE ratio and the y-axis is kind of the expected annualized return for the next 10 years, right? So the higher the PE ratio, you can see the expected returns for the next 10 years is going to be lower. So, and you can see here about 10%, the PE ratio was around 8 to 12 here. So this is about the US market I'm talking about, right? Like Indian market is also, it's quite expensive, right? So if you go to the world PE ratio, I think US is the first market, like in terms of like the highly valued market. India is second, right? So India is also like highly valued in terms of like PE ratio, right? So we can see the chart here. Yeah, here you go, right? So I think from 1995 till now, so we are at almost at the no, almost at the high, right? So I think a few months back, I think August 2024 was the highest. So we are at the high peak valuations, right? So in general, the chart that I showed, right, the higher the valuation, the lower the expected returns in the future is going to be, right? And I wanted to start off by saying that because one is US might seem attractive from, like, if you're an Indian investor or even if you're from any other part of the world, right? US is obviously the most advanced country in the world. So, and also you have all these companies, right? Like, we have Apple, Microsoft, all the things that you're using, right? So it's very hard not to go into the US market and invest there. So I want to start off by saying that, hey, US is attractive, but also the valuation is higher. You also, like, as I showed, right, expected returns is going to be lower in the future. So one is the valuations are high. So that's the first point. Second one is one of the most the things that I've been kind of trying to understand is single market risk. When everyone's talking about index funds, right? Index funds are great, right? Like passive, low cost index funds are great, and it has over and over again, it has proved to be the best investment, right? For an average investor, right? Like, if you're someone who's just doing a 9 to 5 job or like doing your own uh, job, like that's the single best thing that you can do. Invest in index mutual funds or index passive funds, right? But the problem with index funds is it also depends on which market that you're investing in, right? All the people that you're listening, right? Either it's the Indian investors, right? So Indian investors, like for the last 20 years, if you look at the annual returns, it's been around 10 to 15%, right? Like that's a huge amount of return, right? So we're talking about the last 25 years of the Indian market, right? And again, if you listen to anyone from the US market, they will also say the same thing, right? US market has been one of the best performing markets in the world. One of the major problems with investing in a single market, single country, meaning if you're investing in S&P 500, you are basically investing in the US market. Same goes for if you're investing in Nifty 50, you're investing in the Indian market, right? You can see from this chart what I'm trying to say is the magnitude of loss by investing in a single country, right? For example, if you look at USA as a country, right? So between 1929 1932, there was this period called Great Depression, right? The US market went down by 85%. Just that number might not mean anything. Imagine this, right? Just close your eyes and imagine you invested, let's say, 10 lakhs into the US market, right? Let's say you are in the US itself, right? Who knows, right? Invest in the US market. You have invested 10 lakhs. In about a few months or so, right? Your money goes down to 2000, right? 1500, right? So 1500 meaning like 1.5 lakhs, right? So it went down by 85%, right? That's like, you might have earned that money, let's say for 3 4 years, right? And saved up small amounts, right? That might you might have that money for your future, like probably for your health reasons, for your retirement, for n number of things, buying a house, right? So investing in single markets, there have been so many cases in the past. It hasn't panned out well, right? So you can see China, you can see Russia during the World War I, right? You can see so many other different markets, right? Like one of the, I wouldn't say reason, but if you say, last 50 years back, right? Japan went down by 75%. Japan at that time was at the peak of innovation, right? Like even USA was not, I think Japan was like around about 40 50%, like how USA is now. Japan at that time during 1970s, it was at the peak of all of, like, I think everybody was wanted to get into the Japanese market, right? At that time. So having a single market risk, these are the reasons, right? Historically speaking, there have been countries which were doing well and suddenly stopped doing well. And trying to predict which country is going to do well is sort of difficult as well, right? So, what's the solution here? So, I'm saying don't invest in Nifty 50, don't invest in the S&P 500, or like historically, if you look at all these data points, right? Having a single market risk is probably it's if things go south, you're going to lose your money, right? So it's a solution. The solution is kind of buying this index fund called the MSCI World Index. So basically, the World Index invests in uh, almost 20 plus developed markets, right? So you get exposure to all the stocks in the world. Like, why hold only one country's index when you can hold the entire world, right? So I mean, the problem again is investing in MSCI World comes with its own kind of disadvantages. The disadvantages, like the MSCI World Index is the weighting scheme, like the way they weight the stocks, it's market cap weighted. So that means that all the big companies are going to get the high weightage. So now the problem is all the big companies in the world are in the US. So that's why you see 70% of the allocation goes to the US markets. It's almost like buying an S&P 500 without, the 30%, right? Again, this is a problem, right? Because we have talked about the high valuation, we have talked about single country risk, but even buying MSCI World is not the solution because again, you have the concentration of single market, right? The single market country risk. Well, what I found out is like having an equal weight, like if you just simply change the weighting scheme from equal market cap weighted to equal weighted, that reduces your uh, weightage from 70%, which is huge, to 40%, right? To be precise, 39%. So there is this instrument. Obviously, if you're in India, right, you can't buy both of these instruments from the Indian market. So you have to use these kinds of apps, right? You have to use apps like what your IND Money, your Vested, all that apps that lets you invest in the international market, right? So there is this instrument called MWEP, which is in the UK region, not in the US region, by the way. So you can see that like 40%. of the allocation goes to the United States, right? So this is the MSCI World equal weighted. So to an extent, you're diversifying your equity exposure across 20 plus countries with equal weightage to each and every stock, and thereby you're reducing the single country exposure. One of the best things about doing this is that automatically your valuation comes down to. So you can see here the yellow line, right? When you compare it to S&P 500, you can see this yellow line being placed at the lower PE ratio here. So the valuation automatically comes down from, no, the S&P 500 is currently at what? The median valuation is around 32. The equal weighted comes down to 22.9x, right? So this is like no easy win, right? You're still investing in a passive fund. The expense ratio of this is around 0.2%. Again, a passive fund, nothing complicated. Again, like an ETF that you're gonna invest in, right? In like same logic, whatever you're applying to any of the index funds, right, applies to this as well. Now, again, there are so many problems. Like the problem, like with investing is that if you don't take risk, you're not going to get the return, right? Like only the people who are going to invest in risky places, they're going to get the benefits, right? It's like that's almost like the philosophy of anything, right? Like you have to take risk. Like if it's so easy, everybody would be doing it, right? So the problem with investing in any of these index funds is equity index funds is that there are going to be times when equity markets are not going to do well, right? Um, just because you're invested in equal weighted index doesn't mean that you can't face a drawdown of 30%, right? Your portfolio can still go down by 30% if you're invested in equal weighted index. The only thing is that you're not subjected to a single country um, going down, right? And if something happens to, I hope it doesn't happen, right? I hope it's not a strategy, but I hope it doesn't happen, right? Something happens to India for some reason, right? Anything can happen, right? The political game can change, the parties can change. There could be one or two, policies that can completely get the equity market down. If you have invested in Nifty 50, right? It's first going to impact the Indian market, right? Than any other market. So again, coming back to like kind of the managing any kind of equity portfolio is kind of hard because you with a high risk you also have to deal with the drawdown and the downside risk of the portfolio, right? So what's the solution here? So the solution here is, again, it's not foolproof, right? You can argue either way, but one of the solutions that kind of help me see investments or equity investments a bit differently is kind of, you can say by investing you can see this in two ways, right? One, either investments make you rich. Most likely most people not get rich by investing, but at least it helps you preserve your money against inflation. That's one. Second one is, if things go terribly south, anything can happen. Let's assume that the baddest thing happens to your portfolio. Can you still survive that? Right? Like you should not go poor, right? Like if suddenly Nifty 50 goes down by 50%, you should not be on your streets, right? Like it should not be like you don't have the ability to pay the rent, right? So a simple risk framework kind of helps you, especially when things are going bad, is this 200-day simple moving average. So simply, like if market starts going down, the moving average itself, like kind of after a few days, right? Like once it turns negative, you sort of sell it, like you come out of the portfolio, like come out of the equity position, right? So you can think about this as like as simple as let's say last 12 months return. If it's positive, you don't do anything to your portfolio. Once it turns negative, you sell all your equity position, right? And you move that money to a bond allocation or like a risk-free allocation, um, that doesn't go that basically doesn't help you, that basically helps you protect your money, right? So that when equity markets are having very long bear markets like financial crisis or during 2000, right, it can help you. So this is the result, right? When the strategy was tested across markets, you can see that, globally, when things were going south, right, you would have lost 60% without any risk framework, without touching the portfolio at any point in time. You would have lost 60%. And think about the mindset when you lost 60% of your money, right? That's not easy compared to 30%, right? This is like a global market. And there are also other markets, right? European market, the Pacific, the North American market, right? Again, this strategy is not foolproof, right? It's because you're still losing money, right? Like losing any amount of money is not good, right? 30% is again like really difficult, right? Uh, Very difficult to hold something that's gonna. Or it's very difficult to think about something that's gonna lose money. So this strategy helps you kind of at least sleep better at night. If suddenly things go south, right? You don't have to take any action, because when things are going down, it's very difficult because everybody is talking about the worst scenario, right? Think about during COVID, right? We all thought the world is going to end, obviously, right? I was thinking, oh my God, I'm never going to go out. Like, it's just going to be my house and I'm just going to stay here forever, right? Like, people are dying, like all my friends, parents were dying, and it was so brutal. Like 2020 was really brutal, right? When things are going like that, it's very hard to hold a, like when things are going like that and you see your account, like let's say you open your app and your portfolio is down by 30%, that doesn't feel good, right? So risk framework, to an extent, it helps you in a way, right? Finally, I come to how you can implement this risk framework without having to implement it by yourself, right? So if you're an Indian investor, there's no product for Nifty 50, right? That can do this automatically. There might be softwares out there, but I'm just going to talk about the world fund here, right? So in the US, you have these two instruments called PTLC and PTIN. They use the same methodology, like similar methodology about using like 200-day moving average. So what they basically do is, again, if it goes negative, they move their allocation to T-bills, like, or treasury bills in the US, right? These are the safest instruments in the US. And I'm buying these two in the sense, you can construct the MSCI World Index in a way using these two indices. These two funds, right? One is the US large cap, basically mirrors the S&P 500, and this one is the international, right? So basically, you're combining S&P 500 and all the other markets except the S&P 500, right? So when you combine these two, you're gonna simply get MSCI World Index with risk framework built in, right? So the way you can construct the market cap weighted indexes, allocate 70% to PTLC, 30% to PTI, and same goes for equal weighted, right? Like 40% to PTLC. So basically, you're reducing your allocation to PTLC, that is the US market, and you increase your allocation to PTIN. And here is the chart, right? Like, and this is like a 25 years of history we are talking about, right? The great thing about this is the pacer, like you can see the two, blue and yellow line here, that they have almost beaten in from 2000s, right? The without the risk framework. So the green and the violet line, they are without risk framework, right? So you can see that the pacer market cap index is like comes out at the top, and the equal weighted also, it's like, see, I don't see a big difference here at the top, right? So it's probably like a few percentages away. So but the good thing about this is, like, it is giving you almost similar, but it has to play out for like decades, right? You can't expect the same return probably in 2 3 years, right? Because markets suddenly might go down and you might move some of your money to cash. That's how this framework works, right? So over like different business cycles, risk framework has helped you in a way, right? And you can see the CAGRs, right? The CAGRs here are almost close enough, right? Like the annual returns are about 7.5%, right, on average in all of them. But the problem here is you can say that, hey, I'm starting this analysis from 2000, right? Because 2000 is the time when tech bubble happened, the equity market started going down, right? So which is difficult, right? So that's why this strategy proves to be like really great, right? That's where it excels when equity markets going down. But also you can question the strategy, right? Because I'm starting at a point where this strategy actually would do well. If I rebase the strategy, this strategy doesn't look as attractive as it was before, because you can see the blue and yellow lines kind of like down, right? So without risk framework, it's up. With the risk framework, no, it is kind of down, right? The CAGRs are also like there's a meaningful difference, right? 2% among the risk versus the non-risk managed strategies, right? There's a meaningful difference here. But the way I've thought about this is like, can you sleep better when everyone is talking about the doomsday scenario, right? So if you ask me, right, I think this is much better way to see the portfolio or see how you can see the investments itself. Um, think about 2007, right? Equity markets went down by what, 60%. That's what you're seeing here, right? With this risk framework, you could have cut down your losses by 40-50%, right? So instead of thinking your portfolio has like some sort of like you have to make this much return, one other way to think about is how you can cut your losses as well, right? So that's what I've written about in terms of like maximum drawdown, right? So you can see with risk framework, your maximum drawdown didn't go above 20% over the last 25 years. Without the risk framework, it went down by 55%, 53% without the risk framework, right? And because of these, because you're getting uh, kind of similar return but with lower volatility, your Sharpe ratio also goes up. So that's kind of this framework, right? The framework itself, like how it helps you minimize your drawdown during like market crises, like again COVID here, like 2000, like even 2022, right? There was like markets went down. The other side of this strategy is this only works when the equity markets are going to have like a prolonged period of bear markets, right? So that means that 2000, it was like almost like what, 1 or 2 years it took the markets to recover. Same for financial crisis, it took a few months to recover, right? But COVID was like a sharp crash, then markets recovered after a few months, right? During those times, it didn't prove to be that effective during like sharp crashes, but prolonged period of crashes, it does help you protect your wealth, right? Finally, this is my kind of like I haven't completed all my fund transfer yet, but this is my kind of like final portfolio, right? Where I invest about 70% into this risk managed equities. This is basically a world fund, some of them in short term bond fund, right? And I already have quite a bit of money, like about 5% of my money in the sovereign gold bonds, right? So I'm not going to sell them, like gold has been doing well. I think it's also like when it comes to gold, it also helps you protect, like in historically speaking, again, it might not happen in the future, but historically speaking, it protects your money against inflation. And especially when during all these stress periods over the last 25 years, gold has proved to be that one asset class that didn't go down during financial crisis or during COVID, right? It actually proved to be a good safe haven during market crashes. Well, that's it. No, that's it for that's my entire portfolio, right? Like, drilling it down from like what 10 funds to like 4 funds, and this is the performance, right? So this is my Kaushik global portfolio versus a 60/40, right? Um, Again, like, see, the returns here is like, because I'm investing as an Indian investor, I also get the USD-INR appreciation, right? So basically, since I'm investing in INR, since USD has been appreciating, I get about like what 1%, 2% per annum. Like, not every single year the USD appreciates. There have been years when now USD depreciated again, US against INR. But no, overall in the long term, last decades, like 2 decades, it has been appreciated, right? So we also get some kind of extra return just by investing in some US returns. Sorry, US funds. So there you go. Like, that's the CAGR of my portfolio, 10.5%. If you're watching this and you've invested in, let's say, small cap funds and mid cap funds, I can clearly say what you're thinking, that hey, 10% is not enough for me. I'm going to switch to another video who's going to promise me extra returns. The thing that you have to know is that it's very difficult to even meaningfully generate 15% of returns over a long time. 15% is a lot over long term, I'm saying, right? Like, Indian equity markets have done tremendously well, right, over the last 25 years. Whether it will continue, um, again, for the reasons that I've explained before, right? One of the reasons I'm taking this so seriously is because Indian market is still emerging market, right? And see, nothing against India as a country, right? It seems to be ticking all the boxes, but we don't know what we don't know, right? And you don't want your investments to be stuck in betting on one country, right? When you think about diversification, that's the true diversification, right? You don't want all your investments to be subject to one single country doing well on a lot of things, right? Hey, who knows? Like, if Nifty 50 can do tremendously well, and over the next 10, 20 years, India can do tremendously well as well, right? But is it better to be more cautious when it comes to your money? I think that's what I'm kind of trying to do with my kind of portfolio, and I'm trying to shape my kind of investment knowledge as well, right? And trying to make this more kind of long term oriented. And also, I don't want to be someone who just mix and match the portfolio, right? Just for the sake of it. Um, no, I think this has been my like what 4 or 5 years after reading a lot of research, reading a lot of analyzing a lot of funds and mutual funds, right? This is the final four funds that I've come to. It took me so long. By the way, it's not investing is not easy, guys. Like what I'm after analyzing so many funds and portfolios, there's always a caveat. There's always something that you haven't thought through about your portfolio, which you will only think when things go south, right? As long as like bull markets are there, everybody's portfolio, any stock that you're buying is just going up. But when things go down, that's when the real test comes in. I'll end the note on that. If you have any comments about my portfolio, or if you completely dislike my portfolio, I'd like to hear your thoughts in the comments. Thanks a lot for watching, guys. Yeah, see you in the next video.